Hello and welcome to today's webinar on opportunities in 2020 and beyond. It's coming live to you from my home office. I hope you can all hear me. If you can hear me, just give me a thumbs up or a wave or something like that on the chat menu down below. Excellent, I can be heard. I hope you are all keeping well on this somewhat sunny day down here in Essex, and I hope I have got a very interesting, informative seminar for you today. Sunday Times Rich List came out today. Flicking through the pages, I think they've missed me off it. Watching this webinar, hopefully you can take steps and strategies to one day get your name on that list. That's not guaranteed. So let's kick off and let's get cracking with the seminar. We've got a few more stragglers joining us. The webinar is being recorded, so if later on you would like a copy, then it will be available on the YouTube page. Let's get cracking. Before we get on, I just want to highlight a few points, if I may, with regards to the presentation that I'm about to make. And it's just a disclaimer. Today's webinar is for information purposes only. We don't accept any liability for any errors or omissions. And one thing that I really do need to stress is that where necessary, you need to take professional advice with regards to your own financial position, especially tax. We're not able to give tax advice, nor are we qualified. So if you've got any questions later on, which people may do, about company structures and how to do things in tax efficient manner, I'll be addressing that, and my suggestion would be referring to a qualified tax advisor. So if we are all ready, let's go. So it's been a very tumultuous time in the market in the last 8 weeks, in the country in general. And firstly, I know that we've got a number of medical professionals on this webinar today. So just on behalf of everybody, just want to thank you for all the great work that you've been doing and continue to do in the very challenging circumstances. What we have at the moment, differing from 2008, is not an economic crisis, or it didn't start off as an economic crisis. And I think in the whole context of what we're doing, that we should remember that and keep that into the back of our mind. So we're going to start off with where we are now, as in today, how the markets may react. And if you saw my previous video, you will know that nobody can sit and tell you how the market's going to react, but it's going to go either of one of three ways. How to capitalize on the opportunities that may present themselves. And a lot of the things that I will be mentioning aren't necessarily about how they're going to capitalize on the current situation, but just generally in terms of property transactions now, today, tomorrow, and going in the future. How to look for opportunities. I'm then going to go through a quick case study, and then we're going to go to a Q&A session afterwards. So if you've got any questions, please leave them to the end. So where are we now? Making specific reference with regards to UK property and UK property prices. Now, if you look there just on the screen in front of you, I hope you can see that, before I came on today, I just went on to Google and pulled some newspaper topics or what people are having discussions on based on the property market. And generally it is doom and gloom in terms of what is being purported. We will not know what is actually the case until 3 months, 6 months, 9 months, 12 months, when we'll be looking back historically at the time. So everything that you are reading are just people's opinions based on what may happen. And I really think that it's key for people to remember that regardless of what does actually happen, no one's going to be able to tell you that. But generally, the consensus is it's expected to be a dip in the market in the short term. Now, looking at, for example, the mortgage market, especially over the last 8 weeks when the lockdown occurred, a lot of lenders retreated into the backwards and had a wait and see policy. Slowly over time, over the last few weeks, lenders have becoming more relaxed in terms of what they do. And also, as of last week, we've got the ability for estate agents to reopen, people to be able to go and view properties and to survey properties, more importantly, obviously within the guidelines and using the correct PPE. But with where we are at the moment, the general view from the market is that we may have a downward fall in property prices, but the question is just how much. Now, how may the market, as in the UK property market, react to the current situation? So again, it's going to go one of 3 ways. Okay. Now, the argument for prices decreasing are based on a number of factors, and a lot of those are the economic consequences as a result of the lockdown and the view of UK PLC, let's say that, going forward. There is a lot of economic uncertainty. Okay. Now, the last time we were at this situation was around the time of the credit crunch, not the credit crunch, of Brexit, sorry. And with Brexit, what's happened over a 3-year period? We didn't know whether we were going to leave with a deal, leave with a deal, whether there was going to be no deal, what was going to happen as a result of coming out of the European Union. We still don't know the answer to that question. That point has been shelved for the time being. But during that time period, generally what you saw was a lot of people thinking that the future is going to be uncertain. And in that case, as human beings, what do? Generally, we do nothing. So we sit on our hands. And coming up to this situation, just to put things in context, after Christmas, we were expecting an increase in property prices and market transactions. And actually what happened is January was relatively quite slow. And then maybe in about a 4-week window before the lockdown, the number of inquiries of people wanting to move property and wanting financing had gone up exponentially. We were getting loads of inquiries through the door. And then obviously in the current situation, that's settled down now. The reason again for the price decreases is that again, unemployment, there's an expectation that maybe after the furloughing period and when the government removes or decreases the support mechanisms that they've given to stabilize the market, then there will be a rise in unemployment. And also another point that will potentially decrease people's ability to buy property at a certain price is their ability to obtain financing. Unless you're a cash buyer, the market or the mortgage market is going to dictate a lot of things. And if lenders start tightening their belts, then obviously that's going to strengthen the argument for prices to decrease. The other option that could happen is that prices could remain relatively flat or the market could somewhat stagnate. Now, that has happened before, pretty much around the credit crunch. You may have seen a short-term slight decrease in the property prices, but generally, if you can recall back to the time 2008 onwards, people generally just again sat on their hands. If people aren't moving and people aren't buying and there's not a lot of transactions, not a great number of transactions going through, then again, not a lot is going to happen within that period. There is an argument to be put forward, I'm not sure how valid it is that over the last 8 weeks of the lockdown, people have realised or begin to realise that their home ultimately is their castle. Now, we don't know where we are at this moment in time or if what the future is going to hold for us. But I think a lot of people appreciate that being restricted in terms of their movements and spending more time at home, that maybe they want a larger garden or they need more space. So again, I think that plus people who have been putting off financial transactions or moving or moving up the property ladder may realize their situation. And again, and I didn't put there also, is the backdrop of record low interest rates. The base rate in the United Kingdom at the moment is 0.1%. Okay, I am turning 40 next month, and looking at it and looking at the bags under my eyes, you will probably find that very hard to believe, or that I'm anything over 21. However, in the year of my birth, the base rate in the United Kingdom was about 16-17%. And if you are on this webinar and you can remember that time and you did property transactions in that period, you can, I'm sure, appreciate the record lows that we are at that moment. Again, where the base rate's going, it went from 75 basis points down to 0.1 very quickly. Where it's going to go in the future, no one can tell you. But again, there's a lot of consensus within the market that we might be here for some time. Again, that is an argument for prices to increase going forward. Personally, I think we may be closer to the first two options. Now, moving on, how to capitalize on opportunities. Now, the one thing that I want to make clear is whether you are buying a property for residential owner occupation, whether you are buying a property as an investment, it is key and it is fundamental. And I get very animated over this point that, like anything in life, you should have a strategy in place. If you're buying a property for residential occupation, why are you buying that property? How long do you envisage living there? How long do you envisage before you're going to move up in terms of that property? What are the main factors that you want in that property and what you're going to buy for? If you are buying an investment property, or if, like a lot of the clients that I deal with, you are a buy-to-let and a portfolio landlord, what is the purpose of essentially what you are doing? Okay, now, it may be that my purpose is to make money, okay? Okay, sure, fine. You want to make money on capital appreciation, you want to make money on yield, but what is your time horizon, and in what time period do you want to do that? What does the finishing line look like? Because if you don't have that strategy in place, A, we're never going to know if you've ever achieved any of your goals and how successful that you've been, and B, especially for the investors, and I see this so much, they buy, accumulate, grow, get to their old age, God takes them, and essentially they just leave a problem and an inheritance tax, maybe an inheritance tax problem for their family, when they haven't done any planning along the way because they haven't known about what their end goal is. So I really want to lay that point. That is very, very, very important. Also, how to capitalize on opportunities, whatever area that you are looking at, okay, it is important that you know the area inside and out. I get a lot of people, especially down here in the southeast and London, saying to me that I want to go and buy property up in Manchester, I want to go and buy one up in Newcastle or the north because of HS2, Birmingham, because prices are going to increase and this, that and the other. And I say that's all well and good, but what do you know about the market? What do you know about that given street? What do you know about what prices have done historically? If you want to rent it out, what do you know about the liquidity of tenants or the stickability of tenants? How long they're likely to stay in a property before they, give their notice and then start looking at new ones? You need to know that area very well. Now, if you've got professional advice and you've got experienced letting agents up there, then that's fine. But there are a number of tools that are available on the market. The one thing this time has currently taught us is that by sitting in the comfort of our own home, there are a lot of tools that we can use that will help us with doing property transactions. One of them is time to sell analysis. Now, if you go onto my YouTube page, and a link of that will be somewhere or other, then there's a very, very interesting website where it can tell you in a given postcode, in a given area, how long properties have stayed on the market, what their asking prices have been, what the achieved sale prices has been, whether for a certain number of bedrooms, how long they've been sitting there, etc., etc. That can give you very useful information. You can sit on Google Street View and you can go and see any property on virtually any street and have a look around the area and do some due diligence. You can go on to Zoopla, and Zoopla will tell you sold transactions of properties in that area. Zoopla will also give you an indication of what the market value may be within a certain tolerance and give you a confidence interval. If you are looking at buying a property as an investment, you could go into spareroom.co.uk or .com, again it's on my YouTube page, and see what properties or rooms are renting for in that area. So it's imperative that you have the information and the data to hand. It is also very, very important that if you want to capitalize on opportunities, is that you need to move with speed. The deal is not done in the UK until contracts are changed, and then there is some form of element that binds the buyer and the seller. So if there is a property or a transaction that you do want to actually go for, the quicker you get to that stage, the quicker you know that that deal's going to happen. I can't tell you about the countless times that I've had people that have pulled out or changed the goalpost before exchange of contracts, and at the last minute there's drama. The quicker you get to that point, the quicker you know that you've locked in the deal, because before that, either the buyer or the seller, either party, could move at any time. You need to assemble your dream team as well. That is really, really, really important. And again, by your dream team, I mean your lawyer or your conveyancer who's going to do your transaction. And again, if you are serious about property, you should have, or I would hope you'd have, a good relationship with a very experienced property lawyer who may be even able to guide you and give you some ideas of things that you may not have considered. You should have a very good accountant / tax advisor on board with your transactions, especially if you are buying property now and with the tax changes, especially with April just gone, and you are a high rate taxpayer. The structure of what you do things in should be one of the first things and points that you should be considering. And you are only going to be able to do that by having the right advice. Also, with regards to your property finance, whether you do it alone or whether you use the services of an intermediary or broker such as myself, people can bring knowledge and experience to transactions and to a relationship, which later on may prevent you from making costly mistakes. There are other people that you could have as part of that dream team as well, but ultimately you need to have the accountant, tax advisor on board, sort out the finances, which I'll come on to in a minute, the legal side, and maybe a financial planner as well to see how what you're doing is going to affect the context of everything. When you are approaching property transactions, please, please, please be transparent with all parties. If people agree to a transaction on the basis of X, Y, and Z, let's assume that they agree to a transaction because you said initially that I'm a cash buyer, I can get the deal done within a few days or something like that. You are, not a few days, but you know what I mean. You are then giving them an expectation of a certain timeline in their head. If you are not a cash buyer in that scenario, and then you turn around 2 weeks later and say, no, I'm actually in the process of going for a mortgage, you know, the lenders are being a bit slow at the moment and blah, blah, blah. They're like, what are you talking about? We gave you this deal because of that situation. Now, flipping it on its head, if you went to them and said, look, I want to buy this property, I'm going to take financing, but I've already done X, Y, and Z, I'm very motivated, I'm going to get it done, I'm going to give you, you know, weekly updates to keep your seller involved in the process, then again, that is a situation where you need to be transparent with all parties. Keeping liquid, this is a very important point in my opinion. I talk to a number of property developers, people who are buying property, etc., and there's always been the argument, I've got cash in the bank, I can go and buy that outright and then do what I need to do, and then once I've done that and sold that or I've refinanced it, I can then move on to the next transaction. If you are in a market where opportunities are going to present themselves, the ability for you to be liquid, I would say, is very important. Now, of course, don't overstretch yourself or don't do anything that's going to cause you any issues or take on too much at one time. But if you are progressing with deal A and then you see deal B coming across where, again, there is another motivated seller, you being all in on one transaction and something else coming up is going to obviously stop your ability or limit it from going for the other transaction. We are at a time of record low interest rates, so your liquidity is something that you should pay careful attention to, and also know your options. How I work is I try to inform and educate my clients and the people that I deal with of saying, you know, that transaction, do you know you could do X, Y, and Z, or we could get this type of financing, do the work on it, and then we could do. So, oh, I didn't know that. If I'd known that, there's loads of transactions and deals that I could have got involved with. So have that conversation, do your research, and know what options are available to you. Now, time is against us. Opportunities to look for. Motivated sellers in any market, especially coming out now. If you are looking to invest in property, again, residentially, buy to let, commercially, whatever, look for motivated sellers. Let's say hypothetically Doris and Dave have got a property on the market and they're planning to downsize to a seaside town maybe in 5 years' time, and they're putting it on the market with some figure that they may have been given the idea that their property was worth, and if they don't reach that figure, they're not going to sell it because they've got no urgency. Doris and Dave in that scenario are not motivated sellers. Okay, you need people who want to move for a number of reasons, maybe due to job relocation, maybe due to the fact that they've found their dream property and they want to move, or they want to retire, or there's an exit strategy from a business and they're putting their commercial property up for sale. You need to look at people who are motivated to do that transaction, because in those scenarios, there's a greater ability for you to negotiate, and then conversely, there's also a greater ability for you to get a potential deal on there. So I would always do that. Tied properties, again, from the history of time. I'm not teaching you anything in this particular point that's not going to be something that you don't know. Properties where they need some love, they need some TLC, they need some renovation. You can go in there, do some work, and then the property value is going to creep up. Just like you're looking for those transactions, there are other people that are looking for those transactions as well. And going back to my previous point, the speed of which you can go through and get these done are going to be imperative. Now, if you are in the market for property deals, you need to tell people. You need to tell your friends or family or estate agents or people in your ecosystem that you are looking out for deals. So if later on they overhear something or something comes up and they know that you are motivated in that direction, they will tell you. It's not rocket science, but the more people who know what you're looking for, the more potential deals that may come across your desk. Because the deals that come across your desk, you are not going to go for every one of them. You're looking for the diamond in the rough, ultimately, for you to pursue. You are not looking for other people's headaches where they want you to overpay for something, let's say. Okay, changes in a residential property. So where you can repurpose a property is definitely something, and even before this economic situation that we're in at the moment, we were doing quite a few of where you can repurpose a property. For example, a large Victorian house that is been previously let out on a 3 or 4 bedroom basis as one tenancy agreement could be repurposed with the necessary planning permissions to a house of multiple occupancy, to a multi-unit block. And by doing that, you could increase the yield from 5% to 10%. And I'm going to come across a case study of that in a moment to give you an example. But by doing that, you are going to add value. Same footprint, same property, but by restructuring it internally, you could essentially increase the yield that you're getting. And where we are in that situation, it is even more important to go back on your own portfolio and find out, am I making the most of what I have at the moment? Again, using changing a garage into another room, an unused space at the back of a commercial property, getting permission on it and making it habitable, getting properties that are failing the EPC ratings and doing something with that. Again, these are the transactions that you need. Time is against us. Okay, let's move on. You could also maybe use this opportunity if you don't want to get any more property. You may want to get your children onto the property ladder. There are a few mechanisms available to get your children onto the property ladder, and even potentially get borrowing on that basis. Children I refer to being over 18 in that sense of the word, through joint borrower sole proprietor arrangements and those types of things. So even if you don't want to do something but you want your children to start doing that, and maybe they don't have the means in their own right, that could be something worth investigating. Developments, okay, even let's say last week I got contacted by a client of mine who's experienced developer saying, I've seen a site and I potentially want to do X, Y, and Z on it. Developments are generally the preserve of people who are quite experienced in the property market, who know what they're doing, have got quantity surveyors involved, who've got experienced build teams to go in and to do the transactions. But again, there could be opportunities for properties, even commercial property, to be repurposed back into residential. I know with permitted development, some people have been doing that, but if over the next 6 months more commercial property comes onto the market, is there the ability to do that? Joint ventures as well, and proceed with caution. The reason that I say that is with joint ventures, you are financially potentially getting into bed with somebody else. So please do your due diligence. But if you've got money and somebody else that you know very well and can work with's got money, and you bring a skill set and they bring a skill set, then if it allows you to do projects that you may or may not have previously been able to do by putting your heads together, then it may be worth exploring that opportunity. You should have shareholder agreements in place and protection, and speak to a lawyer to make sure that everyone knows what everyone's getting involved with. But that could be potentially something for you to explore further. Now, very quickly, just want to go through a repurposing case study with you. And this case study was essentially came into a force before the lockdown, and an example of some transactions that were happening. So in this particular scenario, a client acquired a 4-bedroom property down here for $293,000 as a standard AST on a standard rental. It would be renting out for £1,200 per month. Took 3 months. Got the permissions, converted it to a 6-bedroom HMO. That was then revalued at £340,000 with a rent of $2,925. Essentially, the client has doubled the yield of the same property. Yes, capital was put in, the property was repurposed, there's extra work. Dealing with HMO tenants isn't the same as dealing with standard tenants on an AST. It might involve more work, but again, a great letting agent or someone who has got expertise on that can take that headache out of your head, so to speak. So essentially, 4-bedroom property repurposed into a 6-bedroom HMO. It resulted in an increase in property price, and it resulted in an increase in yield. And how many properties are there in your given area that potentially could be repurposed and could result in a greater yield? Because the one thing I am certain of is that we live in the UK. We're not in Dubai or somewhere like that. God is not making any more land. There is still a chronic shortage of property in the UK, and even though people are talking about using modular building now to increase that going forward, there is still a significant time lag. So unless we start pumping sand into the Thames estuary and creating another island, we need to have that at the back of my mind. So we've gone slightly over, but I just want to hit you with the top tips, and I please want you to maybe go through and see which of these may apply to you the most. Research is fairly evident. We've put the details on that. Become the expert in your particular area or for what you're actually doing. The ability to move quickly is very, very important. And also, if you do have a transaction where you want to move on quickly, when you're speaking to the selling agent or the person who's selling it, essentially sell yourself as the seller. Look, Mr. Agent, I've got no property that I'm dependent on selling. I've got a pre-approval from bank X, Y, and Z for the transaction that I'm looking at doing. I've got this ready. I've got that ready. I've got whatever ready. I can move quickly. I'm a motivated buyer. Here is what I want to do. Because if they're then presenting 2 deals to the same client, one who may not present themselves in the best way and another who does, then who knows where it will go, but it may go in your favour. Construct your dream team, as I've already mentioned. Keep the end in mind. What is the purpose of what you are doing? So many buy-to-let landlords don't actually, in my opinion, sit down and think of what the end goal is. And we're preparing a strategy document at the moment to help people to come and decide what they're doing and what they need to consider. But most importantly, whether the market goes up, down, left, right, back to front, whatever it does, okay, if you are buying within the strategy of keeping a property for long term, past performance is not the guarantee of future performance. However, I wanted to show you a graph. I couldn't find the best one to do it. I might find one and put it on LinkedIn or something. Short-term fluctuations tend to get ironed out over time. For you to ever call the bottom of a property market, you would need to be a genius, or you would need to have a crystal ball, and you would not be on here on Sunday listening to a webinar with the legendary Riz Malik. You would be sitting on a yacht in Saint-Tropez counting your money. The ability to call the bottom of a market in any market is nigh on impossible. But again, if you look at over time, if you've been in this game for a long period of time, how much was that property that you bought 20 years ago? How much was it 30 years ago? We're dealing with a very, very large portfolio at the moment. And when I do an analysis on it, the portfolio has purely grown because of essentially they bought property a very long time ago, they repurposed it, converted it into flats, added rooms, etc., and the market has risen over time. How can you add value to property? By buying something and improving on something. That's going to add value onto it. Otherwise, you are just riding the market. And none of us have got the ability to influence where the long-term property price goes in the UK, but you can do everything that you can to make sure that you are in the best possible position. I've gone over slightly, I apologise, but we're now going to come on to a Q&A. If there are any questions on here, please connect with me on LinkedIn. We're on Facebook. I've got 45 videos on YouTube that only my mother's watched at this moment in time. There could be some useful hints and tips on there for you to watch, so please check out our YouTube channel. But does anyone have any questions? Let's now take a few questions and I will start looking at them. Type them below. Okay, do you think that the badly named mortgage holiday will have an impact on lenders' appetite, particularly for residential lending? Very, very good question. A lot of people have taken mortgage payment holidays. I was listening to a webinar with one lender. They were saying that they were only given a matter of hours of notice before they're even aware that the mortgage payment holiday process was coming into place. Now, because of that, you've had a lot of banks and lenders struggle with getting things as they are. Generally, if haven't got the money coming in, it's going to affect their liquidity. One thing that mortgage payment holidays are affecting are people's ability to do subsequent transactions. Let me give an example. If I'm a buy-to-let landlord and I've seen a property and I want to go for a buy-to-let transaction, and with the same lender I've got two properties, but I've rung them and I've told them I need a mortgage payment holiday, how do you think they're going to assess that application? If you've already told them you've financially suffered as a result of COVID-19, and it could be because, and we'll come on to the tenant situation another day, your tenants might not have been paying you rent or something, like their propensity to lend to you going forward may be something that they'll look into greater question. I think that's where some people might come unstuck if they hadn't given that thought. Does recent tax implications and reduced tax exemptions make it investing in property less lucrative? A very, very good question, and one that I'm going to defer and say that you need to speak to a tax expert about your own situation. But generally, okay, regardless of when these changes came in, I've still got clients who think that property as part of a balanced portfolio of a long-term basis is something that they would like to do. And this is where especially we deal with a number of high rate taxpayers and even additional rate taxpayers, and they come to me and they say, Riz, I want to do X, Y, and Z. And I'm not giving them tax advice, but I'm saying, okay, please go and speak to an accountant / tax advisor and tell them what you're planning to do, and is that the right structure that you do want to do it with? And then they come back to me, oh, I've spoken to them, and no, they say that I need to do X, Y, and Z. There's a million and one different structures out there, and speaking to the lawyer and the tax advisor could tell you whether you purchase the property within, let's say, hypothetically, personal names. You might do it and change it from joint tenancy to tenants in common. You may do it within limited company. You need to know that before you pursue with any transaction. Okay, so just reading another one. If applying for grant from the government, self-employed due to lost income from COVID, will this affect your ability to get a mortgage? Okay, that's a very good question. And in terms of this is more, I'd say, a situation on the residential market that we're seeing at the moment. There's some lenders that have come out and said that, for example, if someone's on furloughed income and they're only getting 80% of their income, we will use that 80% of their income from the affordability calculation point of view, which again is going to affect how much that you've lent. Any lender is going to be looked at, and they are going to judge, because they are required to do, your long-term ability to service that mortgage. So whether you've got grants from the government, I'm not sure whether that's a grant is different from any other, I'd say, type of borrowing. But for the self-employed particularly, and I am going to shortly do a video on this, I do believe that lenders are going to look and scrutinize applications from self-employed individuals to a greater extent, okay? The reason I believe that they're going to do that is because they are going to be in a position where they need to ensure that there's going to be long-term serviceability of this loan, okay? Now, I've already had and seen information from some lenders, and I apologise we've gone over the time, but if you've still got questions, I'm happy to answer them. I've already seen information from some lenders where they've said if they're self-employed applicants, the underwriter, it may go to an underwriter some further they may go to the underwriter for some further checks, and in that they're going to look at potentially your industry, your job, your market, the cash flow of the business even during the current crisis. All of this information, be prepared if you're doing a mortgage application and you're self-employed, that you're going to be able to have answers for this. And especially any applications that I do on a self-employed basis going forward, I will be putting points to the lender where I'll say the clients in this industry, as a result of COVID, this is how it's affected them. However, this is the situation, and this is why they believe that their income stream is sustainable in the long-term basis. You're not going to necessarily overturn someone's decision if they've decided one way or the other, but it's how you present that information. With any borrowing application, okay, I'm an underwriter. I'm sitting at my desk. I'm looking at hundreds of mortgage applications on a daily basis, okay? That application looks no different to that application, looks no different. I've got a checklist of maybe things that I'm providing for. If you can answer questions or put somebody's mind to ease before they've even asked them, that's definitely going to help, in my personal opinion. And I've had situations before where I've had lenders turn around and say no to me, and I've written a one-page summary, and they've turned around and said yes, and really surprised me in some cases. And I've recently had a situation where, again, a lender was questioning the how the ability of the business was going forward in the current situation, and I wrote War and Peace, and the lender turned around and said no, but they said our appetite is being very restricted at the moment because there's so much uncertainty going forward, and I can't blame them for that. I can't remember the question. I hope that answered it. Okay. Remortgaging. Is it not worth sticking with a standard variable rate for the moment? That's a very good question. Some deals have expired. The problem that you've got at the moment is within the mortgage market, there isn't the same level of competition that there was and there has been previously. So when deals have expired, you are subject to the deals that are available at this moment in time. Now, if, let's say, not as many players are in there, or they're restricting what they're doing, your options are limited. To answer that question again, you would need a crystal ball, because it could stay exactly the same. There could be more applicants into the market within the next 6 weeks, or there could be more deals, or something could happen that again is out of control and it could go down the other way. So I think in that case you might be playing potentially a risky game. Are there any links you talked about embedded in the videos, or you share separately on a video email on the website? Yeah, the videos, all the videos and the content that we do are going to be put on the YouTube video. Do you expect any changes in stamp duty structure due to current situations? Very, very good question. Okay, I like that. With regards to the current stamp duty situation, there is a lot of talk in our industry about how the property market is going to be improved, let's say, if there is a downturn. And a lot of people have been talking about stamp duty. Personally, I'm not sure if that's going to be the case, and I'm not sure if there are going to be revisions in stamp duty, purely because of the need for the government to maybe recoup some of the outlay that they've made. Personally, I think that there's going to be, and I do not have a crystal ball, I think there's going to be an increase in direct and maybe indirect taxation while they try and recoup the money that they've spent out. So I've got a lot of people who are asking me that question on stamp duty, especially the buy-to-let landlords, and I'm not sure, but I would not hold your breath. Someone's typing, we'll take one final question. There's still people on here, so you must be interested in the answers. Okay, it's not a question. Great presentation. Many thanks. Okay, I'm going to close it off there. Thank you very much for your time today. I've brought you 40 minutes away from young children, if you've got them, and if that is a blessing, then you're welcome. I hope you found today's webinar informative. If you do have any questions going forward that I have not answered, then please feel free to drop me a line, and my email is over there. And I would also like to take this opportunity to say that if you do have any further topics that are of interest to you, I'm putting together another webinar specifically for medical professionals and what they can potentially do at the moment with regards to their financing, how their income's derived, etc., etc., and also portfolio landlords and people looking at repurposing properties. If there are any particular topics that you do like and want more information of, then please let me know. As long as there's a demand for this, I'm happy to share my knowledge. May I take this opportunity to thank you very much for your time and to wish you all the best and success in your future endeavors. Thank you very much. Take care.